Okay, hello everyone. Welcome to today's session. Now, in today's session, we are going to attempt June 2024 attempt question number 1. That's Mahoney Company. Okay, so as we solve each and every past paper question, as you move towards the examination nearer, it's important that past papers are covered. So it is our practice that we solve each and every past paper question. All the past papers of the last 5-6 years are available on your LMS portal. Here, the June 2024 question has now been published, so we will solve that. Let's start reading. The following exhibits available on the left-hand side provide information relevant to the question. Okay, let's start reading the exhibits. Exhibit 1. Mahoney Company is a listed holding company based in Eurozone. So company is based in Eurozone. Company and its subsidiaries specialize in large-scale infrastructure projects around the world. Mahoney's board is due to review an investment proposal after being invited to work on a regeneration project by government of ACCA. The objective of the project is to significantly improve the capacity of ACCA's largest shipping port. ACCA has a relatively closed economy with significant protectionist measures on imported goods and services. So ACCA has a closed economy. There are protectionist measures on imported goods and services. Same protectionist measure that government protects its local sector, avoids imported products. ACCA's agricultural sector is the country's main source of employment and has benefited to a large extent from this protectionism. The new government has announced a series of reforms designed to boost economic growth and tackle an unsustainable budget deficit and the country's high unemployment rate. As part of these reforms, government is keen to establish a customs union with its neighbors. Principal objection to this proposal is the harm it might cause to the growth of ACCA's new car manufacturing industry. Okay. Other topics to be discussed at next week's board meeting include how to hedge the disposal proceeds from the divestment of a Brazilian subsidiary, Oliveria, and an intra-group settlement Mahoney expects to receive from its Canadian subsidiary, Viscount. The funds are not expected to be available for 6 months, but will be used to repay a bridging loan, which is due for repayment on same date. A lot of information, so let's listen it closely, observe it closely. What exactly is the discussion in these 3 paragraphs? Okay. So, Mahoney is a listed holding company based in Eurozone. First paragraph is telling us Mahoney is a listed holding company in Eurozone. Company and its subsidiaries specialize in large-scale infrastructure projects around the world. What is the company's specialty? Large-scale projects. Mahoney's board is due to review an investment proposal after being invited to work on a regeneration project by government of ACCA. So Mahoney is based in Eurozone. Okay. They specialize in large-scale projects around the world. They have been invited to work on a regeneration project by the government of ACCA. Now, ACCA is a country. Government of ACCA means ACCA is a country. Mahoney is based in Eurozone, and they have been invited by government of ACCA on a regeneration project. The objective of the project is to improve the capacity of ACCA country's large shipping ports. So they have been invited, Mahoney is invited by ACCA country, government of ACCA to work on their project, which will improve capacity of their port. Now, ACCA country, what about ACCA? ACCA is a relatively closed economy with significant protectionist measures on imported goods and services. You know, you have studied in my classes protectionist measures where government protects its local sector by avoiding imported goods through high duties, taxes, etc. They protect the local economy. ACCA's agricultural sector is the country's main source of employment and has benefited to a large extent from this protectionism. So agriculture sector is the main source of employment. And due to this protectionist measures, agricultural sector has benefited. New government has announced a series of reforms designed to boost economic growth and tackle unsustainable budget deficit and country's high unemployment rate. So new government wants to do reforms, boost growth, tackle unemployment. As part of these reforms, government is keen to establish a customs union with its neighbors. Now, you must know what a customs union is. Okay, because in this paragraph, it's mentioned the government is keen to establish a customs union with its neighbors. So what is a customs union? Custom union is an agreement between few countries who basically promote trade between them, like lower or avoid duties, taxes, and allow the goods to freely move between those countries. Like if you take an example, European Union is an example of customs union because European Union is a combination of 25 plus countries. Okay, the Schengen zone also comes in that. Okay, and they have a free trade area, customs union between them. They allow goods to flow in between them without any border controls, without any duties, without any taxes. So the aim is to promote trade in between them. So new government wants to establish a customs union with its neighbors. That means it wants its neighbors to get into a union with them where they allow free movement of goods and services at lower or reduced tax rate. Okay. The principal objection to this proposal is the harm it might cause to the growth of new car manufacturing industry. Car manufacturing industry is objecting to that because if a customs union is established and other countries' cars, neighbors' countries' cars, companies come in here, so their local car manufacturing sector would be hit. Even their establishing a customs union means the protectionist measures will be gone because now you won't protect your local sector. Customs union means the goods of neighboring countries will really flow between them and your local sector may get hurt. Other topics to be discussed in the next week's board meeting include how to hedge the disposal proceeds from a divestment of Brazilian subsidiary Olivria and an intra-group settlement Mahoney expects to receive from its Canadian subsidiary US. So there are two more topics to be discussed at next week's board meeting: how to hedge sale of Brazilian subsidiary, intra-group settlement. Funds are not expected to be available for 6 months, but will be used to repay bridging loan, which is due for repayment. Okay. Next exhibit seems like a very good netting question. So today is 1st February. Mahoney manages financial risk on behalf of the group, including settlement of intra-group balances. The company has recently introduced a policy to use multilateral netting to settle balances owed between companies within the group. The base currency is euro. Obviously, companies in euro. So base currency is euro. Following balances are owed today between Mahoney and 3 of its subsidiaries. Subsidiaries are YWest based in Canada, currency Canadian dollar, Imran Company based in Pakistan, currency PKR, and Olivria based in Brazil, currency BRL. Owed by owed to, many transactions given and amounts are given. Okay. Balances are converted into euros using the following spot mid rates. So spot mid rates quoted per euro 1. Per euro means euro is in denominator, indirect quote. Okay. And Canadian dollar to euro, PKR to euro, BRL to euro. You know how netting works, that all these are first converted into one single currency euro, and then we make a column of owed by owed to the matrix. Group policy requires balances to be settled in order that a company owing the largest amount in euro settles first with the company owed the smallest amount in euro. Group policy also requires settlement payments to be made in 6 months' time. Okay, pure netting area. Then the third exhibit, divestment of Olivria. Today is 1st February. Mahoney has found a buyer for its Brazilian subsidiary Olivria company. The buyer is still negotiating the purchase price, but the current expectation is that sale will generate net proceeds of Brazilian 650 million, which would be payable on 31st July. Today is 1st Feb, and you have found a buyer for your Brazilian subsidiary Olivria. You expect BRL 650 million on 31st July. So it's approximately 6 months. Today is 1st February, 1st March, 1st April, 1st May, 1st June, 1st July, and 31st July. 6 months, you expect BRL 650 million. Treasury manager is concerned about the exposure to transaction risk and has identified forwards and futures contracts as possible methods of hedging. Following quotations are: exchange rates are given BRL per euro, spot rate, 6 months forward rate, futures 500,000 euro contract size, quoted BRL per euro 1, you are given March, June, September futures. Futures contracts can be assumed to mature at the month end. Basis can be assumed to diminish to zero at contract maturity at a constant rate based on monthly time intervals. Number of contracts to be used should be rounded to the nearest whole number in calculations. If the amount cannot be hedged using exact number of futures contracts, the amount unhedged or overhedged should be hedged using forward market. Okay, this is very important here. The treasury manager is concerned about exposure and has identified forwards and futures. So there is no options, forwards and futures are there. So for forwards, the exchange rates are given 6 months and spot rate. For futures, data is given March and September. Futures contracts can be assumed to mature at month end. Basis can be assumed to diminish to zero. Number of contracts to be used should be rounded to the nearest whole number. Remember, whenever contracts come 191.6, we round off. Okay. If the amount cannot be hedged using exact number of futures contract, amount unhedged or overhedged should be hedged using forward market. Now, remember in currency futures, I taught you a 3-step approach. Okay. First, the lock-in rate. Okay. Then expected receipts or payments using lock-in rate. Okay. And then number of contracts, right? These were the 3 steps of currency futures. Number 1, lock-in rate, expected receipts, payments using lock-in rate, and then number of contracts. Okay. We don't do unhedged working in futures. We do it in options. But there has been a past paper before as well. If examination question demands unhedged working in futures as well, you need to do it in futures as well. Although this may not be completely matching with the class concepts, right? But it depends on the question. Because if this is not the case that we don't know what an unhedged working is. Okay. You know, in options, any unhedged amount, you know, the expected receipts, payments, premium, unhedged. So unhedged is done through forward market. Okay, you know what unhedged is. You haven't done it in futures, only in options. But if the question states to do it in futures, you have to do it. Like it's clearly written, if the amount cannot be hedged using exact number of future contracts, like it's coming in decimals, amount unhedged or overhedged should be hedged using forward markets. So now in futures also, you have to do unhedged working, and unhedged is done via forward market. Okay. Fourth exhibit. So the first exhibit was introduction, then netting part, then the sale of subsidiary futures and forwards, and the fourth exhibit. Amasia, the country who has invited us, Amasia. Amasia's currency is Amasian dollar, which is currently trading at $12 per euro. Investment proposal represents the first phase of a long-term regeneration project. Assume Mahoney will complete the work for the first phase immediately at an investment cost of $1,800 million and then operate the port for 3 years in return for an annual operating fee. This fee is based on expected volume of traffic through the port. And at the end of third year, ownership of the project will be transferred to Amasian government in return for $2,900 million. Finance director expects the project to generate following inflation-adjusted cost flows. Inflation adjusted. So in year 1, 2, 3, the net operating fee from the port is 90, 92, 94, and then the transfer proceeds at the end of year 3, 29 million. Now, what is happening? Please pay attention. Amasia's currency is Amasian dollar. It's trading at $12 per euro. Investment proposal. Remember, government of Amasia invited us for an investment. Now, what is the investment proposal? Investment proposal represents the first phase of a long-term regeneration project. Assume Mahoney will complete the work for the first phase immediately at an investment cost of 1,800 million. What is the investment cost? It's 1,800 million. Then operate the port for the first 3 years in return for an annual operating fee. So Mahoney will invest 1,800 million and then operate the port for the first 3 years in return for a fee. The fee is based on volume of traffic. At the end of third year, ownership will be transferred to Amasia in return for 2,900 million. Now, Amasia government invited us, Mahoney. Mahoney is investing 1,800 million, getting fee for 3 years. 90, 92, 94. And at the end of third year, they're getting 2,900 million from Amasian government. Board intends to finance the project with a loan, but the treasury manager is concerned about the foreign exchange risk of the project. Mahoney's bank has suggested arranging a currency swap with another company. Swap would be for the initial investment cost with a swap of principal immediately and then a swap back in 3 years. Both swaps would be at today's spot rate of 12 per year. Okay. So the Mahoney banks wants a swap. Swap would be for initial investment cost. Okay. Swap of principal immediately. What is the principal? 1,800 million. And then a swap back in 3 years' time. Both swaps would be at $12 per year. Expected annual inflation rates are for euro 8.42%, and for Masia 23, 18, 18%. Relevant discount rate for the project is 16% nominal. Mahoney CEO officer questioned whether the currency swap rate in year 3 would be beneficial based on expected future direction of the exchange rate. As an alternative to currency swap, he suggested using a 3-year currency option for the purpose of hedging the final tier 3 cash flows based on an option premium of 11 million, which is payable immediately at an exercise price of that option of 14.1 per euro. And this last paragraph, CEO has questioned whether swap would be beneficial. So as an alternative, he suggested using a 3-year currency option. Option premium of 11 million, which is payable immediately, and exercise price of option 14. So premium is given for option that you don't have to calculate premium. You know, in option, the expected receipts payments plus unhedged plus premium comes. So premium is given 11 million, and excess price size per option would be 14.1 per year. Okay, that's all. And it's obviously 50-mark question, so heavy information. However, when we will do the respective parts, we need to constantly refer back to the question. Let's look at the requirements. Requirement A, 7 marks. Explain why countries might impose protectionist measures on imports and possible economic benefits if Amasia forms a customs union with its neighboring countries. 7 marks, at least 6 to 7 points required. Why countries might impose protectionist measures. 2, 3 points, 2, 3 marks. And benefits of forming a customs union with its neighbors, where we allow free movement of goods at lower or reduced charges. Okay, 2, 3 points for why impose protectionist measures. 2, 3 points. That's it. Okay, let's start. Open the word processor for part A. Part A is not a report. Okay, so we have to directly read the answer. First, I will explain why countries might impose protectionist measures on imports. Protectionist measures basically mean charging high duties and tariffs on imported products, making them more expensive to buy. This is usually done to protect local industries, as since imported goods are expensive, people will use local products. This is also done so that other imported products don't give competition to local companies, which may not be able to compete and they may collapse, leading to large unemployment. Like in case of AMASIA, agriculture sector is protected this way. Similarly, imported goods, if allowed, may result in foreign currency outflows, leading to widening deficit. Okay, it's mentioned that AMASIA has a budget deficit. So if they don't keep protectionist measures, don't make imports expensive, if imports are cheaper, people will prefer to use imported goods, and imported goods may result in foreign currency outflows, leading to widening deficit. Okay. Protectionist measures are also put in place to generate large revenues for government in the form of tax and duties. Okay, so I have given 3-4 points why countries put protectionist measures. Okay, so countries put protectionist measures to protect the local sector, number one. Okay, and avoid unemployment. Okay, second point, second paragraph. Then avoiding foreign currency outflows. Okay, and they're also put to generate money for the government. So this will gain you 3-4 marks. Okay, so please copy this. Then I will answer the next part. Possible economic benefits if AMASIA forms a customs union with its neighboring countries. This is just why countries impose protectionist measures. Now, what will be the benefits if AMASIA forms a customs union with its neighboring countries? Please copy this. Okay, it was written here that government is keen to establish a customs union with its neighbors. Okay, so I told you what a custom union is. It's an arrangement between few countries who allow reduce protectionist measures, reduce duties, taxes, allow free movement of goods and services between them. Okay, so the requirement is that economic benefits if AMASIA forms a customs union with its neighboring countries. So if AMASIA, you can write the heading benefits of customs union. If AMASIA forms a customs union with neighboring countries, this will bring new companies and products in AMASIA, and new companies incorporation may create more employment. Similarly, arrival of new imported products may create a competition where customers may benefit in the form of low price and high quality. AMASIA's companies will also be able to access other markets, and entry into larger markets may make them a global player as well as create economies of scale. Increased economic activity through this may also help in reducing budget deficit for AMASIA. See, a perfect 7-mark solution that if customs union is formed, new companies and products will come in AMASIA. Okay, new companies may be incorporated. This may create more employment opportunities. And AMASIA already has a problem of unemployment. Similarly, arrival of new imported products may create competition with the local sector, and customers the winner in competition, high price, high quality, low price. AMASIA's companies, the companies in which AMASIA has, they may also move to a larger market. They may become a global player from local sector. And this will create economies of scale for those companies. Like if you have put protectionist measures, you don't allow imported companies or products to come here. Similarly, the other countries will also put counter protection measures. They will also not allow your companies to go there. So if a customs union is formed, they come here, you go there, your companies may become a global player. Okay. And all this protectionist measures removal creates a healthy economic activity, which helps in reducing budget deficit. Okay. So I hope this 7 marks would be earned by students. Okay. You can copy. Okay, so after this, there's a second requirement part. We prepare a report which calculates the impact of intragroup cash flows. If netting is used, then calculates the results of using forwards and futures. Okay, then briefly discusses using results from part one of the disadvantages of policy. Then whether forward or futures market would be better. Compares the NPV in euro of regeneration project in AMASIA and discusses using results from part four above, whether swap or currency option would be better choice, assumptions made when estimating regeneration NPV, whether the regeneration project would be undertaken, professional marks will be awarded. So you know that in a report, all the things come in Word, the report and thing, and the calculations through appendix come in Excel. Okay, so let's start part B, making a report. So in report, you all from date, subject, introduction. Okay, so report is for board of directors. From, if it's mentioned, fine. If it's not mentioned, leave it. Date, I've told you. Subject, 2-3 words. Netting, hedging strategy, and regeneration project. Okay, it's 2-3 words. So this is about netting, hedging strategy, regeneration project. Now, introduction, you all know how I've taught you about writing the introduction. It's this report and all requirements. Okay. So this report calculates impact on intra-group cash flows if multilateral netting is used. Okay. Okay. Then it then calculates results of forwards and futures to hedge disposal proceeds from divestment of Oliveira. Okay. Second requirement gone. It then discusses advantages and disadvantages of policy to settle intra-group balances and whether forwards or futures would be better choice. It then compares NPV in euro of regeneration project in Amasia when either swap or option is used to hedge projects cash flows. Finally, because this is the last requirement, so finally, it discusses whether swap or option will be a better choice and whether regeneration project shall be undertaken, as well as assumptions made when calculating NPV. Okay, so this report and all requirements is basically the introduction. If you want to separate it, it's your choice. Okay, and after introduction, I've told you that all requirements should be made via headings. And then if it's a calculation requirement, just write a statement, refer to the appendix. And if it's a theoretical requirement, just start writing there. Okay, so first requirement, impact on intragroup cash flows if multilateral lending is used. So every requirement will have a separate heading. Impact on intragroup cash flows if netting is used. Results, second requirement, of forwards and futures to hedge disposal proceeds. Okay, every requirement will have a separate heading. I will create space once I'm able to write all the requirements. Don't worry about it. We will make the presentation later. Third requirement, advantages and disadvantages of netting. Future or forwards shall be used. Comparison of NPV when either swap or option is used. Fourth requirement heading. And fifth, whether swap or option is better. Assumptions and decision. Okay, so I have told you that when you start making a report as a format, to from date introduction, to from date subject introduction. Okay, in introduction, this report all requirements. Okay, and then when you start solving, every requirement shall have a separate heading. Every requirement shall have a separate heading like this. Okay, And if you see it's a calculation requirement, if it's a calculation requirement, you just write the statement of referring to the appendix. Okay. And if you think that it's a theoretical requirement, then you just start writing the stuff there, right? Like this impact on intragroup, this is a calculation requirement. I will just write a statement, refer to appendix. This forwards and futures, this is also a calculation requirement. I will just write, refer to appendix, and working will be in Excel. Advantages, disadvantages of netting. This is a theory requirement. I will start writing the answer here. Comparison of NPV, this again seems a calculation requirement. So I will just write appendix reference line. And then whether swap or option is better, again, this is a theory requirement. I will start writing it here. Okay. So this is how things work. Okay. You can start making this format. You can copy this, and then I will start solving each and every individual requirement. Okay. Please note it. Okay, so once we have made all of this stuff, that to, from, date, subject, introduction, this report, all requirements, and then every requirement has a separate heading. Now, if a requirement is a calculation requirement, it will go in appendix. If it's theoretical, I will start writing it here. First requirement, requirement one is calculate the impact on intragroup cash flows if netting is used. Impact on intragroup cash flows if netting is used. Okay, so you know it's a calculation requirement. Okay, so it will go in appendix. I will write appendix appendix 1 shows impact on intragroup cash flows if netting is used. I will write further what is the result of netting, but first solve the netting part. First solve the netting part. So you know that in netting, it's today's 1st February. Mahoney manages financial risk on behalf of group, including settlement of intragroup balances. Company has recently introduced a policy to use multilateral netting to settle any balances owed between companies. Base currency is euro, so base currency is euro. Following balances are owed today between Mahoney and 3 subsidiary companies. Subsidiaries are YWest based in Canada, currency Canadian dollar; Imran based in Pakistan, currency PKR; Oliveria based in Brazil, currency BRL. Owed by owed to is given and amounts are given. Balances are converted into euros. Obviously, if the home currency is euro, base currency is euro, all balances will be converted into euros. And the balances are converted into euros using the following spot mid rates: Canadian dollar, PKR, BRL per euro. So our home currency is euro. It's in denominator indirect code division. And group policy requires balances to be settled in order that the company owing largest amount in euro settles first with the company owed smallest amount in euro. Group policy also requires settlements payments to be made in 6 months' time. Okay. So impact on cash flows if netting is used. Let's start netting. You know the first step of netting. So the first step of netting is into one currency. And that currency is euro. Okay, so convert all balances into one currency. That is euro. So all balances into one currency, I will convert starting it. First is PKR 5913 million. Okay. BRL 160 million. Okay. Canadian dollar 86 million. PKR 3713 million. Okay. Euro 138 million. Canadian dollar 39 million. BRL 504 million. Okay. So all will be converted into euros and the rates are all indirect quotes. So PKR gets converted into euros like this. 5913 divided by what is the PKR rate? 218.1692. Okay. Okay. Then BRL 160 million gets divided by BRL at 5.2131. Okay. Then Canadian 86 million. So 86 million divided by rate 1.31. Okay. PKR 3713 again. 218.1692. BRL 456 again. So, you know, BRL 456. $5.2131. Euro 138. It's 138. Euro 138 is Euro 138, right? Canadian 39. And BRL again. So this is the first step, right? Convert all intercompany balances into one currency. I hope you know the quotes. You just need to divide it. Now, second step is owed by and owed to. And for owed by and owed to, you know that we have to decide about the company. That's Mahoney, Imran. So Mahoney, Imran, Mahoney, Oliveria, Mahoney, Vives. Vives, Imran done, Vives, Oliveria done, Vives, Mahoney done, Imran, Vives, Oliveria, 4 companies. Okay. Total. And here also It's Mahoney, Imran, Oliveria, Vives. Okay, total, right? So in the first line, we will write owed by, okay? And these are owed to, okay? Above is owed by and below is owed to, okay? Here you will get total of owed to. And here you will get total of owed, okay? And then owed to owed by gets deducted. That will be it. I have told these in classes also, no need to rote learn anything, that even if you change the order of owed by owed to, it hardly makes any difference, right? Like some people say, I put owed by here in rows, owed to in columns, doesn't make any difference. Okay, so let's start. Mahoney to Mahoney, none. Imran to Imran, none. Olivria to Olivria, none. Vives to Vives, none. Okay, now let's note the transactions here. Okay, so the first transaction is owed by Mahoney, owed to Imran. Owed by is Mahoney here, and owed to is Imran. In euro, 27.1028, right? Owed by Mahoney, owed to Imran. Okay. Second transaction, owed by Mahoney again, owed to Oliveria. Owed by Mahoney, owed to Oliveria. That's B4, I think. Okay. Third is again owed by Mahoney and owed to Vives. B5. Then it's owed by Vives. So owed by is Vives now. Owed to Imran. Owed by Vives, owed to Imran. B6. Okay. Then owed by Vives again and owed to Oliveria. B7. Owed by Vives, owed to Mahoney. Vives and Mahoney. B8. Owed by Imran, owed to Vives. Owed by Imran, owed to Vives. B9. Owed by Vives. Sorry, owed by Imran and owed to Oliveria. B10. That's it. Let's total of O2. It's sum of J5 to M5. You can drag this. Okay. And total of owed by, the sum of all three. Owed by to Mahoney, J5 to J9, right? Or J8. And you can drag it. Okay. So total of owed by, and we have to deduct total of owed to. 138, 44.12, 118.16, 95.42. So if we deduct owed by and owed to, because that's the main thing, we get net receivable and payable. J, okay. Net, okay, owed by is payable. So payable less receivable, okay. Receivable slash payable, okay. If owed by payable is more, payable is less, receivable is more, so net receivable. And if owed by payable is more, receivable is less, net payable, okay. So these are the two steps of netting, okay. And I will just refer to appendix here in the word processor. Appendix 1 shows impact of intra-group cash flows if netting is used. YWIS has to pay 147.071 million, and others have to receive 14.55 million, 14.35 million, and 118.16 million respectively. So this is how we have referred to appendix, that appendix 1 shows impact on intergroup cash flows, and the results I have mentioned that it's owed by payable is more, receivable is less. So net payable, it has to pay, and whom to pay, others. And you can net off all of these becomes zero. Okay, so I will open the word processor later for the report. First, I think you should copy this stuff. Okay. So because of, I think, some mistakenly pressing of key, one figure is missed, that last transaction owed by Imran and owed to Oliveria, Imran Oliveria, it's B10. So that's unfortunately missed. I think I entered, but it got deleted somehow. Okay. So I think it just got corrected by this. Here it becomes negative, sorry. Oliveria owed to. B10, I don't know why it's getting off again and again. 214.84. Now I think let's see if this becomes correct or not. So I think it's corrected now, and I have to just correct the word file as well. That owed by is payable, owed to is receivable. So YVS and Imran, their owed by payable is more, receivable is less. So they have to pay. And others, payable is less, receivable more, they have to receive from others. Okay. So Imran and YVS, and Imran has to pay 82.33 million euro. Mahoney and Oliveria will receive from them 14.55 and 214.84 million respectively. Okay, you can also net them off to get zero, but I will open this appendix later of Word. First, I think you should copy this calculation. And then, okay, owed by payable is more for these two, receivable is less, they have to net pay. And others, payable is less, receivable more, they have to net receive. Okay, please copy this, then we will move forward. Okay. Okay, now let's move towards the next requirement. We will look at this word file later. What did you wrote? Appendix 1 shows impact on intergroup cash flows. YVS has to pay, others have to receive, and Imran also has to pay. Okay. Now the second is results of forwards and futures to hedge disposal proceeds. The results of forwards and futures is also a calculation requirement. So Appendix 2 shows results of forwards and futures. Forward shows whatever amount comes, and future shows whatever amount comes, right? So Appendix 2 shows this calculation, right? And obviously, this was Appendix 1. I forgot to write here, so you can write it Appendix 1. Okay. And after that, we will move towards Appendix 2, which shows results of forwards and futures. Okay. Now, requirement 2 is calculate the results of forwards and futures to hedge disposal proceeds from divestment of olive area. Results of forwards and futures, hedge disposal proceeds from divestment of olive area. Okay, so divestment of olive area is here. See, this is the appendix, divestment of olive area. Today is 1st February. Okay, so today is 1st February. Okay. Mahoney has found a buyer for its Brazilian subsidiary Oliveria. The buyer is still negotiating the purchase price, but the current expectation is that sale will generate net proceeds of BRL 60 million, which will be payable on 31st July. So today is 1st Feb. You are expecting to sell. That means expecting a receipt on 31st July. So today is 1st Feb, 1st March, 1st April, 1st May, 1st June, 1st July, 31st July. That means we will receive BRL 650 million on after 6 months. Okay. So today is 1st February, and we will receive BRL 650 million after 6 months. Today is 1st February. Mahoney has found a buyer for its Brazilian subsidiary Oliveria. Buyer is still negotiating purchase price, but current expectation is that sale will generate net proceeds of 650 million on 31st July. So today is 1st Feb, 1st March, 1st April, 1st May, 1st June, 1st July, 31st July after 6 months. Okay. Treasury manager is concerned about the exposure to transaction risk, has identified forwards and futures contracts as possible methods of hedging. So you have identified forwards and futures. Following quotations have been obtained: exchange rate, spot rate, 6 month forward rate per euro. You are in euro, you are in denominator, indirect quote division, lower rate buying, higher rate selling. Spot 6 months forward is given. Futures 500,000 contract size, prices quoted BRL euro per euro. Again, euro denominator, indirect quote division. You are given futures for March, June, September. You know this is 31st March, 31st, 30th June, 30th September. Okay. So today is 1st Feb. You are given future for March. To make it more comfortable with the class, today's 1st Feb. You are given future for 31st March. Okay. So 1st March and then 31st March. This is 2-month future. $5.2485. Okay. Then you are given for June, and then you are given for September. Okay. So today is 1st Feb. You are given future of 30th June. Okay. So today's 1st Feb, 1st March, 1st April, 1st May, 1st June, 30th June. You're given a 5-month future. Okay. And September. Today is 1st February. You're given future of 30th September, 1st March, 1st April, 1st May, 1st June, 1st July, 1st August, 1st September, and then 30th September. This is 8-month future. So remember, we have done these types of questions in the class where sometimes future is given of 2 months, 4 months, and sometimes it's month names given. So I convert it into 2 months or 4 months or 6 months. Okay. 5.2956, 5.3427. Okay. So pay attention to all these details. Today's 1st Feb. We are expecting to receive PRL 650 million on 31st July. So today's 1st Feb, receiving on 31st July, 1st March, 1 month, 1st April, 1st May, 1st June, 1st July, 31st July, after 6 months. Futures are given of 3 months, March, June, September, 30th March, 30th June, 30th September, amounts are given. But if today's 1st Feb future is given of 30th March, 1st March, 30th March, 2 months, 30th June, so today's 1st February, 1st March, 1st April, 1st May, 1st June, and then 30th June, 5 months, okay? And then 30th September, 8 months, okay? Futures contract can be assumed to mature at the month end. Basis can be assumed to diminish to 0 at contract maturity. Number of contracts should be rounded to the nearest whole number in calculations. If the amount cannot be hedged using exact number of futures, amount unhedged or overhedged should be hedged using forward market. So usually we don't show unhedged in forwards, unhedged in futures. We only show it in options. Futures only has 3 steps: lock-in rate, precedes payments using lock-in rate, number of contracts. But here is said that any amount that cannot be hedged using futures should be hedged using forward market. So you have to show the unhedged working in futures as well, and you know how does this work. Okay, so what is the requirement in Appendix 2? Results of forwards and futures to hedge the disposal proceeds. So results of forwards and futures. Okay, let's firstly apply forward exchange contract. Let's first apply forward exchange contract. Okay, very simple. How much we are receiving? 650 million PRL. It's a receipt, right? Indirect quote you will divide. Okay, and for 6 months receipt you will read 6 months forward rate. Okay, it's indirect quote because euro is in denominator, division, lower buying, higher selling. In receipt you will sell 5.3117. So this ends the forward one. 650 divided by 5.3117 million euro. Okay, so this is what you get via forward exchange contract. You know, forward exchange is very, very simple. So this is what you get via forward exchange contract. Okay, now you have to perform futures. So let's move towards the futures data. Okay, now futures, there are 3 steps which need to be shown. So first step is lock-in rate. Okay, now you all know that we are receiving money after 6 months. So we need a 6-month lock-in rate, but we are given 2-month rate, 5-month rate, 8-month rate. We need a 6-month rate. So find a 6-month rate. Okay, how we'll find 5-month future rate? 5.2956. 8-month rate. Okay, so you know the trend is a rising trend. How much is the rising trend? Take the difference. J18 minus J17. This is rising trend in 3 months. Okay, so per month rising trend is J19 divided by 3. Okay, this is per month. Okay, so how you get 6-month rate? You have the 5-month lock-in rate. So 6-month lock-in rate. Have the 5-month lock-in rate as J17. The trend is rising. So plus how many months you need to add? 1 month. Okay, so J20. 5.3113. This is the lock-in rate for 6 months. Okay. Second step, expected receipts using lock-in rate. So what is the expected receipt using lock-in rate? Let's find it. So what is the receipt? 650 million BRL divided by 5.3113 equals 650 divided by 5.3113. Okay. And the third step, number of contracts. So in number of contracts, you know that it's 122.38 million euros. And the contract size is 500,000. That means 0.5 million euro. Right? So this equals 122.38 million euros divided by 0.5 million euros. 244.76 contracts. 244.76 contracts. You can round up, round down, doesn't make any difference. We have suggested you to go to round down. You can take 244 contracts, because the problem is if you go up, it makes it 245, creates overhedged. But I have told you for unhedged working to go down so that less amount is hedged and we are always left with unhedged. Okay. So now, as far as the knowledge is concerned, we have completed our stuff of futures, which we discussed in the classes. That first we need to find lock-in rate. We're receiving payment after 6 months. We need a 6-month rate. Okay. We need payment after 6 months. So we need a 6-month rate. So we have a 5-month rate and 8-month rate. We need a 6-month lock-in rate. So we took the rising trend per month, added it in 5 months, but a 6-month rate, receipts using that lock-in rate, and number of contracts. Okay. Now, usually futures end here, but here it's saying that if amount cannot be hedged using exact number of futures, unhedged overhead should be hedged using forward market. So that means even though not learned in the class, but you have to perform some unhedged working in futures also. It's not required in futures, but I've told you during other past paper classes as well that if question asks to do it in futures, then do it. Doesn't ask, then you only need to do it in options. Okay. So unhedged. You know how do we use unhedged? Okay. So first, what is the unhedged amount? Unhedged amount is expected receipts in foreign currency. That is BRL 650 million less number of contracts into contract size into excess price. Okay. So this makes it 650 minus number of contracts into contract size. That is 0.5 million into excess price 5.3113. Okay, this is the unhedged amount. This is the unhedged because out of 650 million, we took 244 contracts at 500,000 and 5.3113. So this is the unhedged amount, 2.0214 million. BRL, right? So this is the unhedged amount. As you know that the working of unhedged is done like this, number of contracts into contract size into exercise price, less the expected receipts in foreign currency. Okay, this is the unhedged amount. And this unhedged will be hedged using forward exchange contract. So hedge it through forward exchange contract. 2.02 million BRL are left to be unhedged, okay, divided by the forward exchange rate. What is the forward exchange rate? 5.3117. It's a receipt. So this makes it 0.38 million euro. 0.38 million euro. This is the unhedged amount. Okay. So we have done the unhedged working as well. Now, what will happen here? I'm just proving one point. Okay. What will happen here? That through futures, just for your conceptual understanding, through futures, you were able to take 244 contracts, 500,000, 0.5 million was the contract size. Okay, so through futures, you were able to hedge 244 and 2.5, 122 million euros. Okay, so you only took 244 contracts, therefore you were only able to hedge 122 million euros to futures. And then the balance was through forwards of 0.38 million euros. Remember, thus the answer came that through forwards 0.38 million euros. So total you will get 122.38 million euros. Okay, so this is exactly the same 122.38 million euros. No need to show this separately. This is the same as you got here. See, I am putting a different color here. Okay, it's the same. But usually I end the scenario here. 3 steps: lock-in rate, expected receipts using lock-in rate, number of contracts. But since the question told me that any unhedge is done via forward, so I have to show the unhedged working. Okay, expected receipts in foreign currency 650 minus number of contracts into contract size into exercise price. Whatever is left through forwards. Okay, 0.38 million euros through forwards. No need to show this thing separately. But I'm just proving one point that even if you show 3 steps, you still get the answer 122.38. No need to show unhedged in futures, only in options. But if the question states that unhedged should be done through forwards in futures as well, so find the unhedged through the same formula of options and then show the working. Okay, so after we will fill the word processor like this, appendix 2 shows results of forward and futures. Forward shows, what was forward showing? 122.371 million euros receipts. 122.371 million euro receipt, and future shows 122.38 million euro receipt. Again, we will show this report later. First, the workings. Forward exchange contract was very easy. Futures 3 steps are very easy. Lock-in rate, expected receipts using lock-in rate, number of contracts, that ends. Since the question said that any unhedged should be used using forwards, so I always round down unhedged, show the working of unhedged, expected receipts in foreign currency, less number of contracts into contract size and exercise price. Whatever left, show through forwards. That's it. Okay, please note this. Okay, so after this futures and options, I think you are done with the B1 of the report, impact of intragroup cash flows, and you're also done with the B2, results of forwards and futures. And the calculation is going on like this. This is a multilateral netting calculation. And this is the forwards and futures calculation. So obviously we have to fill the report as well. Like to from date subject introduction was there. And then every requirement carried a separate heading. If it's a calculation, refer to appendix. If it's discussion, write it here. So first was impact on intragroup cash flows if netting is used. So this was calculations. Appendix 1 shows impact on intragroup cash flows if netting is used. Vivis has to pay 147.07. Imran has to pay 82.33 million. Mahoney and Olivia will receive. Okay. Results of forwards and futures to hedge disposal proceeds. So appendix 2 shows results of forwards and futures. And you can see that forward shows 122.37 million euro receipt and future shows 122.38 million euro receipt. Okay. And no need to discuss further because this requirement was only saying calculate the results. No discussion. It didn't ask for recommend which is better, right? Sometimes the requirement comes recommend which is better. So obviously we have learned that we perform the calculations and then discuss as well. Here only it's calculate the results of forwards and futures. So no need to waste your time. Just calculate forwards and futures, move ahead. Requirement 3. Briefly discuss from part 1 and 2, advantages and disadvantages of the policy to settle intragroup balances. Advantages of the policy to settle intragroup balances. That means advantages of netting. And whether forwards or future would be a better choice. So it's 5 marks. I have to show the advantages and disadvantages of netting. Maybe 2-3 marks for this. 2 advantages, 1 disadvantage, 1 disadvantage, 1 advantage, 2 disadvantages, 3 marks. And whether forwards or future would be better. Okay. So since you see both are discussion requirements, advantages of netting and futures or forwards would be better. I won't refer to appendix. I will write it here. So advantages and the disadvantages of netting. No need to refer to appendix. Start writing here. Netting as an advantage that it results in number of currency transactions being minimized, which saves time. Similarly, reduced number of transactions also result in savings in transaction cost. However, netting has a drawback in terms of legal issues, as some jurisdictions don't allow netting as they believe prevention of flow of cash reduces taxes, etc. for them. Okay, so I've said 2 advantages and 1 disadvantage of netting. This will earn 3 marks for me. That netting as an advantage, number of currency transactions being minimized, saves time. Reduced number of transactions also results in reduced transaction cost. But you know, I taught it in the classes that netting has some legal issues. It's basically I pay to you, you pay to other countries. So there are a lot of transactions in countries, but when you convert all into one currency and then settle intragroup, there are a reduced number of transactions. So countries don't allow because they say that there is no movement of cash flows. So it prevents the financial income from taxes or transaction cost to us. So these are some issues. Okay. So I think 3 marks for this. Whether forwards or futures would be used. Okay. From the results of above calculations, futures is generating 122.38 million euro, and forwards is generating 122.371 million euros. Although a very small difference exists between them, but on financial side, company will opt for futures as it produces higher receipt, right? 122.37, 122.38. Okay, a very petty difference. So from the results above, both are not giving any much material difference, but on financial side, company will opt for futures because you have been taught that in receipts, you prefer the one offering higher option, and higher option is futures. Just to elaborate my answer in increasing one or two lines, forwards carry risk of default and futures carry basis risk. Therefore, directors need to carefully decide which to choose, as financially both offer almost equal returns. Okay, this was just to elaborate my answer, that you know that I have taught you that forwards carry risk of default, futures have a basis risk. The directors need to carefully assess and then decide. I think this will yield 5 marks for you, because the advantages and disadvantages of netting was also considered, as well as whether futures and options should be used. Okay, futures or forward should be used. Okay, so please copy this so that I can move to the next part. Okay, so advantages of policy of netting, whether forward or future are better. No. 7 marks and then 8 marks, 15 marks are left. Requirement 4 compares the NPV in euro of regeneration project in AMASIA when either swap or option is used. So you need to compare NPV. That means you need to find two NPVs in euros of regeneration project when either swap or option is used. Now, I think for the NPV of AMASIA, exhibit 4 is there. Okay, so let's read it. AMASIA's currency is Amasian dollar, which is trading at $12 per euro. So it's in direct quote denominator. Investment proposal represents first phase of a long-term generation project. Assume Mahoney will complete the work for the first phase immediately at a cost of 1,800 million. Then operate the port for the first 3 years in return for an annual operating fee. Fee is based on expected volume of traffic to the port. At the end of third year, ownership of the project will be transferred to Amasian government in return for $2,900 million. Finance director therefore expects the project to generate the following inflation-adjusted cash flows. So remember, you were planning to invest, Mahoney is a company, it was planning to invest in a project of government of AMASIA. So project requires investment at a cost of 1,800 billion. After 3 years, AMASIan government will buy it for 2,900 million. Year 1 to 3 cash flows are given, and this is the cash flows of transfer proceeds, and this is our following inflation-adjusted cash flows. Board intends to finance the project with a loan, but treasury manager is concerned about foreign exchange risks. Mahoney's bank has suggested arranging a currency swap at another company. Swap would be for the initial investment cost with a swap of principal immediately and a swap back in 3 times. Both swap would be at today's spot rate of 12 per euro. So board intends to finance the project with a loan. There is a risk attached. So bank has suggested arranging a currency swap. Swap would be for initial investment and swap back in 3 years' time. Both swaps would be at today's spot rate of 12. Inflation rates are euro, AMASIA, discount rate 16%. CEO officer questioned whether swap rate in 3 years' time would be beneficial based on expected future direction of exchange rate. An alternative to swap, he suggested using a 3-year currency option for purpose of hedging the final year 3 cash flows based on option premium of 11, which is payable immediately. The exercise price of that option would be 14.1 per euro. Okay, so you see that the investment is costing 1,800 million, generating the following 3-year cash flows, and then 2,900 million final year. Board intends a swap for initial investment as well as 3 years. Swaps would be at 12 per euro. Inflation rates are given, discount rate 16%, and CEO is saying, okay, that as an alternative to swap, use 3-year currency option for the purpose of hedging final year 3 cash flows. Option premium is 11 million and exercise price is 14.1 per year. Okay, now requirement is you need to compare the NPV of project with either swap or option. Okay, so NPV is required in swap and option. Okay, now you need to pay attention to one thing, that my requirement is to compare the NPV of regeneration project in AMASIA when either swap or option is used. So you need to find 2 NPVs when one is swap is used and one option is used. Okay. AMASIA's currency is Amasian dollar. It's currently trading at $12 per euro. Investment proposal represents the first phase of long-term regeneration project. Assume Mahoney will complete the work for first phase immediately at a cost of $1,800 million. Then operate the port for first 3 years in return for fee. Fees based on the traffic. At the end of third year, ownership will be transferred to Amasian government in return for 2,900 million. Finance director expects the following inflation-adjusted cash flows. These are the inflation-adjusted cash flows. Year 1 to 3, this is the fee and transfer proceeds. So we are investing 1,800 million, getting fee for the 3 years, and then 2,900 million for the government. Board intends to finance the project with a loan. Treasury manager is concerned about the foreign exchange risk. Mahoney's bank has suggested arranging a currency swap with another company. Swap would be for initial investment with a swap of principal immediately, and then a swap back in 3 years' time. So swap is for initial investment, that is 1,800 million. Principal immediately, swap back in 3 years. Both swaps would be at 12. Okay. And expected annual inflation rates are as follows. European inflation rate, Amasian inflation rate, discount rate 16%. CEO questioned whether swap in year 3 would be beneficial based on expected future direction. As an alternative to swap, he has suggested using a 3-year currency option. The other option is use currency option for the purpose of hedging final year 3 cash flows. The option is only for final year 3 cash flow. based on option premium of 11, which is payable immediately. Exercise price of the option is $14.1 per. So the CEO has suggested to use option. He has suggested using an option for the purpose of hedging the final year 3 cash flows. Only hedge the year 3 cash flow in option. An option premium is 11 million euros, payable immediately. Exercise price of option is 14.1 per euro. And remember, option is only for hedging the final year 3 cash flow. Requirement is compare the NPV in euro of the regeneration project when either swap or option is used. So you need to compare NPV when either swap or option is used, because they're suggesting two options. Let's find two NPVs in case of swap, in case of option. First, NPV if option is used. Okay. Now, you know that NPV for option and NPV is a 3-year life. Since you're investing in AMASIA, all the inflows, outflows will be in AMASIan dollars, like this, 3-year life. Since you're investing in AMASIA, all inflows, outflows will be in AMASIan dollar. Okay. So how much is the investment? $1,800 million. Okay. What is the fee being received? 92.94. And then in the end, we will sell it to Amasian government for 2,900 billion. Okay. So let's net them all to get net cash flow in Amasian dollar. Now, if you look at the requirement, NPV is required in euros. Okay. So since I am Mahoney company, my home currency is euro, and I'm investing in a project in Amasia. Okay. So all the inflows, outflows will be in Amasian dollars. Net cash flows, I will not keep that cash flows here. I will remit it to my home country, called remitted cash flows, or called NCF euro. Okay. But for that, I need an exchange rate. What is exchange rate? Okay. Exchange rate is given dollar per euro. Okay. So now the exchange rate is 12. Per euro. That's an indirect quote I will divide. What is the year 1, 2, 3 rate? Okay. Sir, we are calculating if option is used. Okay. So the question has given that option will be 14.1, but option is only for year 3 cash flow. Option is only for year 3 cash flow. How to convert year 1 to cash flow? Because I need exchange rate to get the NCF in euro remitted cash flow. Okay. You are calculating if option is used. You will use option rate, but option is only for year 3 cash flows. So what about 1, 2? Now, in that case, we know that for one, sorry, 0, 1, 2, 3, you need exchange rates. So exchange rates can be found via purchasing power parity theory, because you are given rate of dollar per euro 12. Okay. And you are given inflation rates of Europe and Asia. Now dollar is in numerator, so this rate will come in numerator, this in denominator. Okay. So purchasing power parity theory will be applied. 12 into 1.23, 1 plus country 1 inflation rate on country 2 denominator. Okay, 8%. Then 18% and 4%. 18%, 4%. Then 18 and 2%. 1 plus country 1, country 2. So you got the exchange rates. I was asked NPV in euros of this project. So investment $1,800 million, fee, and then proceeds, net cash flow dollars. I have to convert it into euros. So I need an exchange rate. I have been given dollar per euro. I can calculate exchange rates, but we have to find NPV if option is used and then if swap is used. So option rate is given 14.1. Okay. But the thing is that this is only for year 3 cash flow. For other years, I needed it. So the exchange rate for year 1 will be converted by year 1 rate. That is K48, then L48. Okay. And year 3 rate wouldn't be converted through year 3 rate 17.94, since I'm calculating not normal NPV, but if option is used. Option is used only for year 3 cash flows, and the rate will be 14.1. So I will convert it at 14.1. Okay. Since I am now remitting money, I'm in Mahoney. My home currency is euro. Okay. Since I'm remitting cash flows. Okay. My home currency is Mahoney, euros, denominator indirect quote. So divide it. Okay. Now, after remitting, if there are any more cash flows, you need to handle that. There are no more cash flows, but since you are calculating NPV in case of option, in option, you also have to pay a premium immediately in euros. That is 11. Okay. No other cash flows. So I get NCF in euro as 161. Okay. Now discount factor is 16%. You can find the factors of 16% or also use the NPV function. It's your choice. NPV, bracket open, discount rate, NCF from year 1 to last, C58 to E58, bracket close, plus NCF of year 0. Okay. If you wanted it via the normal discount factor and then present value NPV, it's your choice. No worries. But I have calculated NPV if option is used, and then now I will calculate NPV if swap is used. But you can copy this. Remember, what's the concept? It asks NPV. So NPV is investment dollars, fees, income, proceeds, net cash flows dollar, converted exchange rate not given, find via purchasing power parity theory, you get remitted cash flows, discount factor, present value NPV. But the thing is that once I do this, I could have multiplied with discount factor to get NPV. But the thing is that it asks for NPV if option is used. Okay. Now, if option is used, remember cash flows are converted in the last year 3 cash flows being applied through option. So I converted it via 14.1. Okay. Because option was used. Remitted cash flows because now option is used, and then an option, a premium was also paid immediately in year 0. Okay. At cash flows euros, discount factor, present value NPV, I got NPV in euros if option is used. Okay. Please copy, then I will calculate NPV if swap is used. Okay. Okay, now requirement is compare the NPV of regeneration project, whether swap or option is used. So I found the NPV in case of option. Now I will find NPV if swap is used. The requirement is same. I need to find NPV if swap is used. Okay, let's find NPV if swap is used. Now I want to find the NPV if option is used. Now NPV if swap is used. So let's understand what swap is. The board intends to finance the project with a loan, but treasury manager is concerned about the risk. Mahoney's bank has suggested arranging a currency swap. Swap would be for the initial investment cost. Swap is only for initial cost. Okay, with a swap of principal immediately. Okay, and then a swap back in 3 years' time. So swap is only for initial investment with a swap of principal immediately and swap back in 3 years' time. Both swaps would be at today's spot rate of 12. Now, this is very interesting. Swap is not for these cash flows. Okay. Swap is only for initial investment, that is 1800 million, like option was only for year 3. So swap is only for initial investment, swap of principal is immediately, and then swap back in 3 years' time. Now, and then year 3, both swaps are at 12. Okay, so let's start NPV if swap is used. Okay, so for NPV, there is a 3-year life. Okay, so NPV if swap is used, what is the investment? 1800 million. Okay, what is the fee? 90, 92, 94. Okay, and then what is the proceeds? Sale to government, 2900 million. Okay, we net them all. We get net cash flows in Amazian dollars. Okay, net cash flows in Amazian dollars. Negative 1800, 90, 92, 2994. Okay, now I need NPV in euros. That's my requirement, NPV in euros. If option is used, if swap is used, so NPV in euros. So I need to convert them into euros to get NCF in euros. And this is also called remitted cash flows. Okay, for that, I need an exchange rate, which is given dollar per euro. Now, what about exchange rate? Now here, you cannot take these rates directly. Okay, it may be same, but you cannot take these rates directly because you need to find NPV, not normally, but if swap is used. Is swap for every amount? No. Swap is only for the principal investment. Okay, 1800. Swap would occur at today's rate 12. Okay, and then a swap back in 3 years' time. Swap back in 3 years' time. Okay, so in 3 years' time also 12. Swap is for the principal amount at today's rate 12, and then in 3 years' time. But what about the mid years? Nothing mentioned. So you have to take the normal rates. So what are the normal rates? Through parity theory, 13.67. Okay, what about here? Nothing mentioned. 15.51 through parity theory. Remember, same was the case with options. Same was the case with options. Okay, because you needed to find NPV, not normally, otherwise I would have taken these rates if option is used. So if option is used, I took the option rate, but that was only for year 3. So for year 0, 1, 2, the normal rates by parity theories. Okay, now NPV swap is used. I've got NCF. Normal NPV I would have multiplied with this converted it via normal exchange rates. But since its option is used, if a swap is used, so I need to use the swap rate. Swap rate is not for every year. For principal, immediately, that is 1800. Initial investment, swap is only for initial investment, 1800. Swap of principal now, swap back in 3 years. Okay, so I need to take the swap rate, that's 12, and then 3 years, swap again at 12, but for mid years, nothing mentioned, so parity theory. Okay, pay attention. Remitted cash flows, it's J59, sorry, J60 divided by J61, bracket. Okay, now for the last year, please pay attention. for the last year, there is a slight mix-up which you need to avoid. For the last year, there is a slight mix-up which you need to avoid. What is that? Okay. In the last year, the rates are not mentioned. If rates are not mentioned, I would have taken the 17.94. Okay. If nothing is mentioned, I would have taken 17.94. But the problem is that swap is for principal at 12 now. Okay, principal. And then a swap back in 3 years. And again at 12. Swap is for principal with the principal now immediately, and then swap back in 3 years. So in 3 years also, I will get a swap of 1800. I will get a swap of 1800 at 12. Okay. Since in last year it's inflow. So I will get a swap. Please pay attention. It may be a bit confusing for you. I will get a swap of 1800 back at 12. Okay. But in last year, I'm not getting only 1800. I'm getting 2994. So whatever the leftover is, 1800 minus 2994, the leftover is 1194. So that 1194 in last year will be dealt through that 17.94 rate. Please understand this workings. It may be a bit complicated and many people may lose marks here. Okay. Now NPV is not being computed normally. Otherwise, I would have just taken 17.94 through the parity rates. If NPV swap is used, so NPV option is used. So remember in last year's free cash flow, the option was 14.1. So I took 14.1. Here NPV swap is used. Swap is for initial investment, principal immediately. So principal immediately at 12. That's the spot rate. And then also a swap back in 3 years. Also a swap back in 3 years. So in 3 years, I'm getting a swap back. How much? Swap was for initial investment. So 1800 only. What is the swap rate? 12. But in year 3, I'm not getting 1800. I'm getting 2994. So remaining 1194 will be via normal parity rates. Okay. So this will give me remitted cash flows. Okay. And I can take the discount factor 16% to find the present value or NPV. Alternatively, I can use the NPV function equals to NPV bracket open discount rates. That's 16%, comma, NCF of year 1 to last. That is K62 to M62 bracket closed plus NCF of year 0. That's J62. Negative 1.17. Okay. Now the only problem here may be this. Okay, only problem here may be this. So I need you to understand this thing carefully, that it's a normal NPV requirement, that NPV in euros. So I would have just written investment, fee, proceeds, net cash flows, dollars, exchange rates given, parity theories, NCF in euro, discount factor, present value NPV. The only problem is NPV is if option and if swap is used. If option is used, option was only for year 3 cash flows. So I took it at year 3 cash flows 14.1 and applied the premium also 11. Otherwise, everything else is normal. Okay. And option was not mentioned for other years. So I took the parity rates. Okay. And BWIF swap is used, everything normal, but swap was for year 0. Now investment at 12. And also the swap was for last year back. Last year back, the swap was 1800. Okay. So it's swap now at 12 and then a swap back in 3 years. Okay. So if swap is now for 12 and back in 3 years is also for 12, but a swap is for only initial investment. So only 1800 at 12, I'm getting 2994. What to do about the remaining 1194? It's via the parity rates. Okay. So there was no discussion required here. Compare the NPV of regeneration project with either swap or currency option is used, since it was a calculation requirement. So I need to refer to appendix, that comparison of NPV when option or swap is used. Appendix 3 shows NPV when either swap or either option is used. In case of option, NPV is euro 14.8 million negative. And in case of swap, it's 1.17 million negative. Okay. No need to comment because that is not required. Okay, I will show it to you later. First, I think you should do the workings here. Okay. I'm opening the word processor part as well, because this is the appendix 3. So this is what we wrote in that word processor portion in the report that appendix 3 shows. That's right, this is appendix 3. And NPV when either swap or option is used, and in case of option, NPV is euro 14.8 million negative, and in case of swap, it's 1.17 million negative. So you can copy this as well, because the report is also now a very good style report with 2 from date subject, then introduction, then first requirement, then second requirement, then third requirement, theory right here, and fourth requirement. And then it's the last one, which I will move later. Okay, so now we are moving towards the end of, I think, requirement 4 compares the NPV in euro of regeneration project Namasia and whether either swap or option is used. The last requirement is discusses using the results from part 4 above. Now, this is entirely related to part 4. Okay, discuss using the results from part 4. So no need to refer to any other parts, only focus on part 4. Discuss whether swap or option would be a better choice to hedge the risk associated with MACA, whether swap or option is better. Swap option, which is better. Assumptions made when estimating the regeneration project's NPV. What are the assumptions made? And whether regeneration project should be undertaken. Okay. Now, whether regeneration project should be undertaken is just 1 mark. Decision whether you should take this regeneration project or not. Assumptions made, you write 2-3 assumptions, 2-3 marks, 3-4 marks in total. Whether swap or option should be used, 2-3 marks, so you can earn these 8 marks. Okay. And since it's a discussion requirement from part 4, obviously I will refer to the report, because I have to now move towards the report, not refer to appendix. Now the report is quite better. 2 from date, subject, and introduction. Report is quite better. Okay. I have done all the workings. Okay, comparison of whether NPV, whether swap or option is used. I've done this as well. Now the last option, whether swap or options is better. This requirement I'm doing, whether swap or option is better. Okay, and assumptions made, and whether the generation project should be undertaken. Okay, so whether swap or option should is better. Now, if you look at the spreadsheet, NPV of a swap option is negative 1.17, and of option is 14.87. Okay, so both NPVs are negative. So whether swap or option should be used, Both are producing a negative NPV, but if we just find the better one, swap seems better because this is giving you 1.17, this is giving you 14.87. So first write this word. As far as NPV is concerned, both options and swap are producing negative NPV of 1.17 and 14.87. Is it? Yeah. So both are not too beneficial. However, on financial grounds, swap is producing a less negative NPV, so it should be preferred. You can elaborate further. This is mainly because since currency rates are expected to go to 17.94 in year 3. See, without option and swap, the currency rates are going to 12, 13.67, 15.51, 17.94. So currency rates are expected to go to 17.94 in year 3. We got swap at 12 and option at 14.1, right? Swap was at 12, right? And option was at 14.1. So even though currency rates are 17.94, we got swap and option both at good rates, which is beneficial, but swap has a better rate of 12 compared to 14.1 of option. And also option has a lot of premium involved in the start. Eventually, both these things are favoring swap. Okay. Why both these things are favoring swap? Because option and swap both are better, because without them, the rates would have gone to 17.94. I got option at 14.1, swap at 12. Both are better, but swap's rate is more better at 12 because we are dividing. You divide by the lesser rate 12, you get more receipt, right? You divide by the lesser rate 12, you get more receipt. If you divide by a higher rate, less receipt. Lower rate divide, more receipt. Okay. So swap is better, but option and swap is better rate 12. And option is also getting worse because of the high premium involved. So in any case, whether swap or option is better, I think things are favoring swap. Okay. So I think it's enough for 2.5 marks. Okay. Assumptions used. So let's look at the requirement again. Assumptions made when estimating NPV. So assumptions made when estimating NPV. This is my NPV. Any assumptions made while estimating NPV? You know some assumptions, right? Following assumptions were made while finding NPV. It has been assumed that cost of capital will remain constant throughout life at 16%. Remember, this is an assumption I taught you, that cost of capital remains constant, tax rate remains constant. In this question, there is no tax rate, so I cannot write this, but cost of capital is there. So I'm assuming cost of capital will remain constant. It is assumed that exchange rates depend on inflation rates. Remember, I have computed exchange rates via purchasing power parity theory. So if I compute via interest rate parity theory, I will assume that they depend on interest rates. If they are calculated by purchasing power parity theory, I am assuming they depend on inflation rates. This is also taught. Okay. Any more assumptions while calculating the NPV? See, some assumptions are present. This is taught. This is everything is taught. Some assumptions are mentioned from the scenario and some you have to write on your own. Assume Mahoney will complete the work for the first phase immediately. It is assumed that Mahoney will complete first phase almost immediately. Okay, this is also an assumption. So no other assumption mentioned. So I will find if I can make any other assumption as well. So I'm not sure that there are any more assumptions, so I can move on here. That following assumptions are made. So just to gain professional marks, I can write one line. Any changes in above estimates may significantly change NPV of project. So I have given whether swap or option is better, assumptions made. Now whether regeneration project should be undertaken. Okay. Last. As far as financial side is concerned, regeneration project is not successful as it is producing negative NPV. So both shall be so. It should be rejected. So again, professional marks, if you have an advice, a questioning thing, you can write that. However, NPV of swap option is slightly negative. So company can negotiate swap rate further. And if it is negotiated, company may get a positive NPV. Swap was just 1.17 million negative. So this is very big negative. So it should be rejected. But if you renegotiate the swap rate, get a better rate, your NPV can get converted into positive. Okay. So this is it. And we have got a good report. And this has ended our question. Okay. We have made a very good report from this. Okay. You can copy this and this ends the question. Okay. Thank you.